Merry Christmas and welcome to a special episode of The Art of Investing. Today we'll look back at some of our favourite moments from Series 2 to round off 2025. From bold calls to arguments to wisdom, we've got it all. Please enjoy the episode. Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. In this next clip, Lee Freeman-Shor lifts the lid on what really matters in this market. How you behave when you're winning or losing. It's a great reminder that great investors aren't the ones who pick the most winners, but the ones who cut losers fast and stay honest about their own psychology. And so you've managed to put them into 5 tribes, haven't you?
Yes.
3 when you're losing,
Yep.
And 2 when you're winning.
That's right. So let's look at when you're losing. So when anyone's losing, they'll fall into one of 3 tribes. You'll become a rabbit, or you'll become an assassin or a hunter. You don't want to be a rabbit. If I found rabbits on my team, I'd shoot them. That's
And then put them in the casserole.
Yeah, and then put them in the casserole. Yeah,
Farmer Shore.
Farmer Shore, yeah. But just to explain what each of them is. So a rabbit is a person that does nothing when they're losing. The danger of that is, if you're down 50%, it takes 100% to get back break even. If you're down 90%, you need 900% to break even. People don't appreciate how hard it is to get out of a hole once you've dug a big hole. And that's why I call it a rabbit. And also rabbits, if they're on a road, a car's coming, they get stuck in the headlights, don't know what to do.
Can I just make that just easy for everybody? So when you say, if it goes down 90%, let's use an example. Stock goes from 100 to 10.
Yeah.
It's gone down 90%. To get back to where you bought it, it has to go up 900% is what you're saying.
Yeah, and I don't know many ideas that go up 900%.
And that's the key point. People need to understand that percentage moved down and the percentage moved up. And it's critical to realize that's why rabbits struggle.
Basically, that's why you'd need an NVIDIA to get you out of it if you're assuming you've been in NVIDIA all this time. The other categories when you're losing are assassins and hunters. So an assassin, which most of my guys were, they're people when they find themselves down 20 to 40%, they'd just kill the position. They'd sell, get out, just move on.
Right.
The beauty of that is you're limiting the damage done. You're not impairing your capital. You're leaving enough on the table to live another day. So that's a good trait. They're never going to lose big. Hunters are basically people that when they're losing, they're prepared, again, when they're down to something like 20 to 40%, they're prepared to throw a lot more capital at the idea. It's not pound cost averaging. It's just to get to a point where they're maybe down 30%, and they just go, well, nothing's wrong with my idea. I still believe in it. I'm going to take it from a 5% position to a 10% position. Very few people are hunters because when things are going wrong and you play with your mind, it's hard to double up. But,
you've got to be really well psychologically set up for that, haven't you? Because, if you think about that, I've got my position, it goes down 25%, I double that position. Now it goes down another 25, 30%. My losses really now starting to stack up. I'm probably not sleeping at night.
Yep.
I'm having trouble seeing straight, and I can't see this company as anything other than if it fails, I've ruined my career. But if it hasn't failed, it's still going to be a problem sitting and languishing where it is. So what you're saying is it's really difficult to find anybody who can be a really successful hunter.
Yeah, I'm a mix of an assassin and hunter, but there was one name which will remain nameless, where I took a hunter approach and I had a big position, and where position size is important. And I got to the point when I started it small, knowing that if it goes wrong, I'm prepared to add to it if nothing's wrong. Added to it, kept going against me, to your point, Chris. And when I added the 3rd time to make it a big position, I actually felt physically sick. Mm. And then you realize, my God, you need strong constitution to do it. And that was in a very high conviction name. But then I know, well, it's a toss of a coin whether this name idea works or not. So, even me, and knowing all this, it still plays with your head. So far easier to be an assassin, get out when it's going against you than a hunter.
And so I can remember this well because, you're at the situation, you're working at an organization, and you get the tap on your shoulder from the boss. So when you're losing a little bit of money, Everyone says, well, that's fine, never mind. Then you add a bit more, now you're losing a bit more money, and everyone's starting to focus a bit on your profit and loss and how you're doing, and do you really know what you're doing? And then you put a bit more on, and you think, I put this on because I'm so sure about it, and that minute the boss comes up and taps you on the shoulder and says, are you sure? And you know, if you get it wrong, your career's over. And the number of people then who just cut the position out, having bought it all the way down, cut it out, they take a big loss, and they're now psychologically impaired for everything else they do.
But sometimes a tap on the shoulder is good.
Oh, absolutely.
So, I mean, I have one example where the legendary hedge fund, he's now retired, but he's a hedge fund investor, very successful. He invested in a super group, Super Dry, which I think probably the listeners know about if they've got the clothing.
I remember this one.
Yeah. So this is a guy usually does when he's losing, assassin gets out, but he invests in the company and it was down about 40%. And I'm looking at the screen, I'm like, he's done nothing. This is weird. So I pick up the phone, ring him, what's going on? Gives me a waffle about why it's great investment, why he's sticking with it. And then I sort of go, okay, so you're gonna throw more money at it then? He's like, oh no, I can't do it. Would you buy it? So if you had a blank piece of paper, would you buy it today? Well, that's unfair. No, I wouldn't. But and then he said, okay, let's go for a glass of wine at the Arts Club. And you go, okay.
Which is, by the way, something that often happens in the city. if you're unsure, a glass of wine often helps. That's what I've been telling myself my whole career anyway.
Anyway, you go to the Arts Club, have a couple of glasses of wine, and he's telling me why it's a fantastic investment and why he wants to stay with all this. So I said to him, okay, so tomorrow when I go back to my desk, I'm going to see that you've doubled your position. Go back to my desk, fire at my trading screens, see that he's sold it.
Wow.
And that's crazy because that's a guy with 20 plus years experience, fantastic investor. This one name got really slightly got tied up with it. But he realized, he couldn't bring, blank piece of paper test, would you buy it? He couldn't, and he sold it. And when I met him, several months later, he thanked me for saving a lot of money by sort of tapping on the shoulder. But then when I met him 6 months later, this is the other flip side of it. He said, actually, no, it's my best idea now. It's probably my highest conviction idea. And it wasn't in his 10 stocks. So I said, hold on, you're meant to be investing in just 10 stocks for me. You should be there. And he looked at me, so I went, right. And to his credit, he put it back in and made me a lot of money. But that just shows that even if you're really good, you have discipline, sometimes an idea can get a hold of you psychologically, sunken cost bias and down bias, and it's just hard to do the right thing.
All right, here's one of the moments that had us all laughing. Spice gets a little poetic, then reminds us why getting emotional with your winners is a terrible idea.
It does sound to me, Spice is a bit more of the romantic. He might find his forever love. And Spice, are there any positions that you have held for a really long time or intend to hold forever?
You all know my oil stock, but there was one where I did make a lot of money, and it started as a company called Acorn Computers, which was the BBC Computers. It ultimately became Arm Holdings. And
which year are we talking about? We're talking about
so this is in the mid-90s, 98, 99. Just as the tech bubble was going, Acorn Computers owned this big stake in Arm Holdings. And then Arm Holdings floated, and I had the position in Arm because I owned Acorn Computers. And I held this position. I held it all the way through the tech bubble, I bought them for pennies in the pound, and I sold them in April 2000.
Right at the top.
Right at the top.
Oh,
but on that day, they had fallen 20% in the one day. I literally walked around the block and went, oh my God, this is a proper crash coming on and I thought this is really the end of the tech bubble. And I walked back in the office and I sold my entire holding 20% down on the day.
Wow.
It was a very good decision with hindsight because then the shares then plummeted all the way down to below £1.
Top of the market.
But you don't get that very often, but I had held it all the way up. I'd trimmed it occasionally where, wanted to buy things as you do. But without doubt, for me, that was my best position and the best managed position by me. Because I didn't mind selling it 20% down when it had already gone up 20-fold or whatever it had done.
Here, we jump back to episode 14, where Mark lifts the lid on the world of circular deals in tech and AI, and why these flashy self-funding loops can be a real warning sign for markets.
What do you mean by circular deals?
So in this case, basically, OpenAI have basically agreed to buy up to 10% of AMD shares, and they've got warrants as well. And so effectively, they're going to give AMD money for their 10% stake. In return, OpenAI are going to guarantee to buy computer chips off of AMD, AI computer chips off of AMD. So effectively, OpenAI are funding AMD to build the chips, and then they're buying them anyway.
Which is exactly what we saw with NVIDIA already, wasn't it?
But I think it also is indicative of the fact that there's a real shortage of high-powered computing chips that are sort of to be used in AI applications. And that's why people are trying to secure supply in the long term. And it will be at the expense of companies in the UK, Europe, and even places like China. And the Americans are all over this trying to make sure they can get as many chips as they want, or they anticipate they want, over the next 5 to 10 years. It's a huge market.
The thing that worries me there, obviously, is OpenAI now has $1 trillion of commitments that it's made, and it doesn't have cash. So, it's loss-making. It doesn't have the cash, so it's going to rely
Rich,
on...
you're such a wet blanket on this stuff, mate, aren't you? You're such a wet blanket. Just believe.
Next bull story, please. Let's go on.
Do you realise, during the internet bubble, the companies found it hardest when they actually started making money. The ones that went up the most were the ones that didn't make any money. Of course, because when you start making money, you can put a proper valuation on the company rather than theorise about it. And, maybe we're seeing a bit of that now. Now, ChatGPT, which is part of OpenAI, already has subscriber revenue, and that will increase and increase as it grows. And as you remember, a few weeks ago, Google, they were being investigated for having a monopoly in search engines, and that was thrown out because there is this growth in other search engines like ChatGPT, like Perplexity, like many of the others that are coming.
Just joining you a little bit in the grizzly camp, just for a second.
Come over, it's fun here.
It is interesting how everyone is becoming so incestuous by linking their companies up together. I read a very interesting article on that this week, which basically said there's nothing inherently wrong with that. I mean, the Japanese did it for many years with their with each having cross-shareholdings in companies, and that's how Japanese industry did work before it all went wrong. And the problem is, what happens when it goes wrong is everybody goes wrong together. So if they go up together, they will all go down together because they've got all these relationships with each other, which they're locked into. So it's fine while the music's playing, as we've said before. We just got to be very careful, watch for those signs, but no signs at the moment. But it's just, we've seen this film before.
And in this next moment, Adam Smith, ex-special advisor, pulls back the curtain on the infamous Truss mini-budget. The panic, the process, and even a chancellor who thought he was being prank called. Here's the story you never heard. Everybody listening to this and watching will be saying, ask him what actually happened behind the curtains during that Truss budget.
The Truss mini budget. Well, so thankfully,
how long have you got?
Well, thankfully, I wasn't there for the mini budget. I was only there for the clear up job. But what basically happened is that for reasons that I think boggle the mind, they decided to ignore the process that I've just outlined and completely ignore the OBR. Actually, they got rid of the Treasury top civil servant who was very well respected almost immediately as they got in, and just decided they would plough on with everything they wanted to do. So in that scorecard process, they were just turning stuff on and not really worrying what
about the bottom right
number,
yeah, green or red.
And actually, my view really, when you sort of go back and look at, and everybody forgets the biggest single item of spending they had on there was the energy support package.
Yes,
it wasn't actually cutting the top rate of income tax or whatever else it might have been. I actually think if they had followed this process, the OBR would have probably come back and said, you need to cut some government spending or maybe make that energy support package less generous. And then they probably could have got 75% of what they wanted through the normal system. The lessons there are, you have to go through some sort of process. We can debate whether the OBR is too powerful, not powerful enough, doesn't have the right expertise. You can't just have a free-for-all.
Is there any other times that you know of in history where the OBR have basically been ignored to that extent? If you like, the arrogance of a chancellor said, well, it doesn't really matter because what I say goes. And markets will fund us whatever.
The OBR, I don't think, has been ignored to that extent. There have been very rare occasions. Actually, we had one in the spring statement where the government of the day has sent one particular policy to the OBR either late or with not enough information. And the OBR has said, we've included this in our numbers, but we aren't able to certify whether that costing is right because either, we didn't get the data we needed or whatever it might be. And they publicly say that. So, and the government then just decided to carry on anyway. So they've been sort of ignored. And I think that's happened 2 or 3 times since it was set up in 2010. But it's never been point blank ignored.
And then you just got a phone call from Jeremy Hunt and he said, right, we've got a job to do.
He was appointed on the Friday in October of 2022. And I got a message to say, could you be at the Treasury that afternoon? I had quite one of those ridiculous experiences when he first turned up for work. So I got into Westminster and I was told, actually, he's still in number 10. Can you meet him there? So I went to the gate and, they have, as you would expect, fairly tight security. So I said, my name's Adam Smith. I'm Jeremy Hunt's new advisor. And the guy must have misheard me or something because he said, you're not Jeremy Hunt. Jeremy Hunt's in there. And I said, no, I'm Adam Smith. And he couldn't find me. And I was like, well, this is a great start. And at that point, I got a message to say, nope, he's leaving, get to the Treasury. So I scurried round Whitehall and I managed to arrive as he was greeted by the permanent secretary and walked in with him. So it was sort of seamless timing in the end, but a bit of a farcical start to my career as a Treasury advisor.
Was that the same time, and this is a great story, I've seen Jeremy Hunt being interviewed where he says that he was in, now was he in Holland?
He was in Brussels,
He was in Brussels,
yeah.
And he got a phone call from someone who claimed to be Liz Truss saying, are you able to come and talk to me? And he thought, this is an absolute joke. Yeah. Someone's taken a mickey. There's no way somebody's trying to get hold of me. So he put the phone down and he carried on walking around. And in the end, the Downing Street switchboard on about the 15th occasion said to him, this is the Downing Street switchboard. Would you please hold for Liz Truss? So he, all right then. And she said, will you be my Chancellor? And then he had to fly back and do it. But, can you imagine? He thought this is one of those hoaxes, like we're always hearing about somebody getting phoned up, pretending to be someone. It's actually a radio DJ or something. Yeah. And he thought that was what was happening to him.
Up next is Stu Thompson on the real reason why every institution wants an economist and how political pressure can lead even the smartest experts to miss the mark.
So why, Stu, does everybody need an economist? Why do we find that every investment bank, every fund management group, every business group, most parts of government, the Treasury, the Bank of England, et cetera, why do they all need economists? I mean, surely you're all studying the same stuff. I mean, how many views can there be?
Well, if you listen to the great George Bernard Shaw, he'll tell you that if you lay all economists end to end, you'll never reach a conclusion. But let me tell you a story about Wayne Angel, wonderfully named economist. So after the dot-com bust, an investor in the States sued one of the major investment banks there, a company called Bear Stearns. And he sued because he'd followed Wayne Angel's forecasts and lost money. The head of Bear Stearns stood up in court and said, Wayne Angel, former governor of the Federal Reserve, professor of economics, and one of the most respected economists in the world, we consider him to be entertainment. In other words, we expect him to write weekly reports to send out to clients to generate business.
I think you've just given the chairman a great excuse when that portfolio goes red.
Yeah. I mean, I was just following Stu.
Entertainment only.
So you've got economists, at the central bank, which are obviously influenced by the politicians. You've got economists at the IMF, you mentioned earlier, the International Monetary Fund. Their forecasts have to be in agreement with governments, so there's politics there. So there's a lot of politics in how economists work.
That's great to hear, but isn't that just an excuse? When people get it wrong, they say, it wasn't me, Governor. I was being lent on by somebody to have that view. The chairman, sorry. And to me, the problem with economists is they fit into my normal view of economic commentators. I used to have a boss at Mercury. He was brilliant. He was a bond market legend. And he had an expression that if you don't have a position, we shouldn't listen to your view. And what he was basically saying was, if you're not experiencing the gut-wrenching disappointment when things go wrong, or the joy when things are working, you can't really judge what your view is on anything, because you've got to face the conclusions of what you're saying as that investor. Whereas an economist can just say, I think this, and he's wrong, and who cares? And he says, that, who's wrong? It doesn't matter.
My forecast said this.
Yeah, my forecast was this. I thought that was going to happen. I was completely wrong, but hey, never mind. Now, it's a perfect example of that. Perfect example. And I've got many, but I'm only going to do one because otherwise the yellow and the red card's going to come out. And we talked about it earlier, the non-existent recession in 2022 and reaction after COVID. So after COVID, everybody cuts rates. We do lots of QE and all that sort of stuff. Money supply picks up, inflation picks up. Every economist, well, perhaps not you, Stu, but most economists say it's temporary. This is not a problem. We carry on feeding the animal that's the bull market. Mark's getting happier and happier. Hey. Inflation's picking up, but nobody's doing anything about it. Suddenly inflation's 10, 12%. And the Fed say, we got that one wrong. We better raise rates. So they got it wrong, first of all, saying it was temporary. Then the US, the UK, Europe, we all raise rates. And every economist then says, it's going to be a recession. 22 is going to be awful. It's going to be a recession. Everything's going to collapse. They were completely wrong with that as well. Now, if I back those judgments as a fund manager, I'd lost my job. Most of those economists are still walking around telling me what's going to happen this year and next year. So tell me what I'm missing. Why is it that they have been so successful in generating salaries and reputations when in fact most of them have got it wrong?
Well, look, economists are a special breed.
Say what you really mean.
Yeah, we are a special breed, but we're not born with perfect foresight. We don't have crystal balls, that's for sure. I think one of the problems in economics, if you're thinking about the central banks making their forecasts, is that if it's not in their model, then they can't see it. And what happened after the pandemic with that inflation, with the supply chain disruption, wasn't in their model.
Well, Russia invaded Ukraine and the oil price doubled, and that gave the inflation boost that you're talking about, really. So to be fair to the economists, that was wasn't something you could forecast, is it? It's not something you could forecast.
And as I say, economists aren't always allowed to say what they mean. And let me give you an example. When I worked for a Japanese investment bank, I was working for Nikko, one of the major investment securities houses in Japan during the 1990s. The Japanese government lent upon those securities houses in Japan. They weren't allowed to say negative things about the economy. The economy was in a balance sheet recession. And by what I mean by that is the assets had fallen in value below the level of debts, and companies' balance sheets were paralyzed. Now, I was working out of London, analyzing the Japanese economy for our clients, and I was able to say, look, the economy is in trouble. Bank of Japan will have to keep cutting interest rates. My colleagues in Tokyo weren't allowed to say that, but they were pleased that I was able to say that because that was what economists really felt about it. But people who believed from the Japanese government and from those Japanese securities houses, got it wrong. And that was actually the fatal mistake of Nick Leeson.
Now, Spice tells us why he thinks the next 12 to 18 months could be a sweet spot for markets, doesn't he always? From AI tailwinds to the perfect Goldilocks setup. I think we're getting to a really interesting point in the next 12 to 18 months because the benefits of AI are going to start coming through. Now, that gives us disinflation, which is great. So maybe that does take us back to the target. And dare I say it, Trump is right. However, at the same time as giving us disinflation, does it take jobs? And does it move that unemployment rate higher to 4.5%, 5.5%. So I think we could be in a world with 3% interest rates, 4% inflation, and 5% unemployment. What benefits in that scenario, Mark?
Well, I think you've forgotten one big thing, the one big, beautiful bill.
Oh, it's so beautiful.
It's beautiful.
So
absolutely beautiful.
As a counter to your AI disinflation that might be coming through in time and a little bit more increase in unemployment, which we've talked about in previous episodes, that might be an impact, particularly for people in the tech industry, the younger people in the tech industry coming through. There is the one big, beautiful bill coming through, which means there's going to be a load more manufacturing jobs coming through as companies are forced, because of Trump and his tariffs, to put manufacturing factories into the US. They're going to employ people who don't have that tech background. They will pay them real wages because there's a shortage of those sort of people. Real wages for those people could go up, and employment could offset that sort of AI effect. Net, you could have unemployment again begin to sort of fall, which would be great. And so you could be going into this near perfect, what you call a Goldilocks environment, where you're getting moderate growth of sort of 3 to 4%, which would be great.
Moderate, that's brilliant.
Yeah, well, that'd be great. I know you guys would say too, but sort of, I think 3 to 4 is what I would think is likely to happen. Unemployment steady, not sort of too bad, and inflation coming down from a peak of around 3.2 at around Christmas time, trending lower, and interest rates falling at the same time. Now, when you have an economy that is doing that, and goes on to what the impact of Jackson Hole, but when you have an economy that's growing at a reasonable rate, inflation is under control, and interest rates are falling, typically stock markets have fantastic years. And I was looking back over the last 25 years, we've had 3 examples of that. And basically the S&P 500 has risen over 30% in every single one of those years. The average has been a 35% rise in the S&P 500. NASDAQ, it's been nearer 40% on average in years where you have this combination, which I think we're going into, which is why I'm so positive.
And in this next clip from episode 10, Charles Hall takes us back through the rise and slow erosion of the UK stock market and asks whether the last 25 years of decline really have to define the next 25. It's a brilliant reality check on how we got here and what needs to happen next.
See, when I started in the city, Mark as well, the London stock market was regarded as one of the most important stock markets in the world. We were nicely situated between the Far East and America. So we were in the right time zone. We were even more important in that stage than America. It was really the stock market. We had a pension system which was envied by everybody at that stage. This is the late 80s, early 90s. And my simple question is, what the hell happened?
Yeah, it's been like boiling a frog in that we didn't see it happening in plain sight for year after year after year, whether it was politicians, whether it was people in financial markets, whether it's the pension fund managers. This has been a problem that has been brewing for 25 years. And you're absolutely right to mention pensions. It's at the heart of it. And the reason for that is pensions are the biggest asset. For pretty well everyone, it's the only big asset aside from their house. And we used to have pensions invested in the stock market. And when I started at Cazenove, if we wanted to raise money for a company, we went to a range of pension funds. Those were the funders of company growth and investment. And over the last 25 years, that's gone. And there are numerous reasons, which I won't bore you with. It's about taxation. It's about Gordon Brown changing the dividend tax reasons. It's about accountancy. But what's actually happened is that those pensions that were fully funded, that were defined benefit, which meant that they paid out based on your final salary, those used to be invested in the equity market, and now they're invested in gilts and in bonds. If you actually do the maths, you can work out that £1 trillion worth of equities have been sold over the last 25 years. So a vast amount of money. It's amazing that the UK market still exists when you imagine the selling pressure every single day. Spice mentioned earlier, it's all about demand and supply. It is. So if you have one of your key drivers of funding for companies selling relentlessly, that's precisely what happens. So it's not just that. Obviously, we've had some self-inflicted wounds as well. The financial crisis back in 2008 was worse for the UK because we had a banking system that was over-leveraged. So that was the sort of start of the economic issues. We then had austerity. We then had the Scottish vote, and people forget that. What was it, 2014?
Yes.
I think it was 2014. Yep. That was uncertain for the UK. Were we going to start breaking up? Then we had a little vote in 2016. Don't know if you remember that one.
Which one that was.
I forget. But and whether you agree with it or don't agree with it, what it meant was we then had
4 years of uncertainty about politics, about our role in Europe, about our economic performance. Global investors were questioning the UK. And then COVID happens. We got hit by COVID more than pretty well any other country because we did a huge lockdown. And then we had inflation, tear-away inflation post the Ukraine war. And that really hit us hard because we were more exposed to oil and gas coming into the country. There's another topic about net zero and Ned Miliband, but maybe come back to that one. Too much information in that one.
I can't upset too many people in one podcast.
So what we've had is a lot of hurdles to jump over. And what this has meant is that for many years, international investors have put the UK bottom of their investment list. They would almost go anywhere but the UK. Why is that important? We've had sellers of pension funds for all the way through this period. Who would be the buyers? It would be the overseas investors. And for as many years as I can remember, they've been net sellers. So the interesting thing is, I think we're now at a turning point. There's a long history of issues in the UK market that has resulted in poor performance. And you know what investors are like. They look at what the track record has been. And we see that in funds. We see that in shares. People like to buy things that are successful. The UK has been palpably unsuccessful in stock market terms. And as a result, a lot of funds have gone underweight. The question now is that right for the next 25 years in the same way as it's been right for the last 25 years?
Let's jump to Chris Bowie on why the best opportunities in the bond market come when everyone else is nervous and how the nervy middle is where the real investors earn their stripes. So, Chris, you've now seen the portfolio live in front of your eyes. What would be the attractiveness of adding corporate bonds to a portfolio?
Yeah, this is where I'm going to actually bang the table at risk of getting a red card here and saying, come on, guys, why have you got short-dated gilts? Yes, they have defensive characteristics. I can give you similar defensive characteristics, but some more lovely income every year. You can have short-dated investment-grade corporate bonds. These are high-quality companies like Vodafone, like Tesco we talked about earlier. I can pay you 1.5% more per year with very similar capital risks. Now, we talked about compounding earlier in the series. The compounding power of that income over many years is going to make a huge difference.
And when you say short-dated, you mean, just for the benefit of our listeners, when we first explained, we talk about something up to 5 years maturity. Is that what you're defining as well?
That's how I would define it, up to 5 years. Because
So what you're saying is high-quality, short-dated corporate bonds. So you're talking about names like Next, BP, whatever. You can pick up 1%, maybe 1.25%, maybe above the government rate. So if you're happy buying those shorter dated bonds in the government market, why wouldn't you be happy buying them in the corporate market?
Exactly. In today's market, you're getting about 1 to 1.5% more. But sometimes you can get a lot more. If we wind back to the Liz Truss era, you were getting 3% more for high quality companies, even for only up to 5 years of maturity.
Isn't that the point? The point is that when there's a bit of a crisis, when something goes wrong, allegedly Liz Truss caused a crisis. We haven't yet got to the episode where we discuss Liz Truss, but that will come at some stage.
It's coming soon.
Because of what she did and the way the markets reacted and started to panic, that then led people to worry about whether there was going to be a recession coming into the UK. And because they worried about recession, these corporate bonds went to yields that became more attractive, i.e. they gave an income level much higher because people were wondering whether they were actually good to pay their dividend and their income. Is that right?
Absolutely. You've nailed it, really, that you get paid more income because you are taking a little bit more risk. Now, with shorter dated high quality companies, that risk, I would argue, is very manageable. Even with the Liz Truss scenario, Tesco is not going out of business over the next 2 years. You can argue about over 20 or 30 years, maybe they're going to have a deteriorating business and therefore their yields should go a lot higher. But over 2 years, people are still going to be buying food and Tesco are still going to be making good profits.
I suppose the point I'm trying to make is it not better to wait for that crisis period, then buy your short-dated corporate bonds, than having a long-term holding in them? What's your feeling on that?
So it really comes to a concept of interest rate risk, and the longer dated a corporate bond is, the more sensitive its price is to a change in yield. My argument would be own short-dated credit through the cycle because even when the yields rise, the capital losses are so small that your income is more than compensating you. But if you buy longer dated corporates, your timing is very important, because if you buy at the wrong time, you could face substantial capital losses. If you wait till they're cheap, then you could enjoy those capital gains on top of income for many years.
Okay, so that's clear. So you're saying for the shorter dated corporate bond market, although they will move around in terms of how they trade, net over time, the return over the cycle will be great. Longer term corporate bonds, you've got to be a bit more careful about when you do that. Okay.
Exactly. But there can be years when government bonds substantially outperform, such as 2008. Government bonds were up maybe 13% that year. High quality corporates were down 10%.
Wow.
But in most years, on average this century, you've had 1.5% more per year from high quality corporates.
I remember that year very well, because that was when I started at one of the firms, and I started working with Chris, and we had to go to see the life company investment committee because they saw our performance and it was so dreadful on that year, because in that year, equities had done pretty badly. Government bonds had done really well, but corporate bonds had done quite badly. Then, of course, the government came in and rescued the financial system, and suddenly all those corporate bonds were suddenly money good again, and everyone was very happy. So actually, it was a very good ending to the story, just a little bit nervy in the middle.
Thanks for joining us for this special episode. We hope these highlights kept you entertained and may even have taught you something along the way. And to be sure to check out the next bumper session with Stu Thompson and his outlook for 2026, out on Friday, Jan 2nd. We'll be back for another big year of markets, debates, and portfolio moves. We'll see you in the new year.